things are looking topsy-turvy, and you may look at Nvidia 1, you may look at crude 2nd, you may look at Nasdaq as 3. The bottom line here is that this is for the second time we've seen what could be called as an across-the-board risk-off sell-off. And the big departure, I think, is that post-Fed, you normally would imagine that emerging market equities will do well when Fed is talking about a rate cut. You would imagine that when everybody is talking about a rate cut, which is evident, the dollar index goes down and commodity prices, they go higher. But what we are seeing is, perhaps for rightful reason, which is that markets across the board, be it metals, be it Bitcoin, be it emerging market equities, US tech stocks, everything had become bloated and they had reached Humpty Dumpty proportion. So markets were due for a correction. The bull market is not over, but I guess the bull market correction in a sense is now different from, this bull market is different from what we've seen, let's say 6 months ago, 3 months ago, which is that it is time to say hello to volatility, and that is what it is. For the day, we are in for a tough day, and for global markets, let's see how things really settle. The advantage, or I will not use the word advantage, I see the situation not very scary, simply because this is not an event-based sell-off. There is no macro factor at play. There is no reversal of a yen carry trade. In my book, this is a sharp profit booking induced correction which was overdue, and when you see this kind of a correction, surely it will have an impact on India.
I think more than that, you are seeing oil prices and that big cool off. We'll of course address that in greater detail as well in the show. The fact that oil prices plunged a good 4% on expectations that, the political unrest or dispute that has currently halted the Libyan exports may actually be resolved, and concerns over global demand growth, of course, have once again emerged. So that's the crude cool off picture for you. And that also perhaps is going to at least have a bearing on the sentiment on the India markets and how some of the crude sensitives pan out. But can they really resurrect us from the global weakness of the day? I guess that remains to be seen.
Yeah, and just to add to that, Aisha, the fact that September is usually or historically a fairly volatile month, I guess investors are also bracing themselves for what could be laid out for the rest of the month. But that aside, let's talk about our own markets. Yesterday, it continued to remain a very flat session. Yes, we continued to advance for 13 straight days on the trot, but it was nothing to shout home about by way of levels. But it's interesting the way the sectoral picture actually played out, because IT sort of finally put a bit of a break on the kind of winning streak that we've been seeing. So 6-session gaining streak, that was put the brakes on, and it was the banks that continued to advance. And coincidentally, the financial services index was one of the top sectoral gainers. Nikunj, just going by the kind of fund flow data, what we're seeing sectorally play out, how is it that one should be really looking at playing this market?
See, the mistake one should not do is go and buy crude sensitives, because you want a situation where crude is down and everything else is in our favor. It does not work this way. Crude is down and other factors are also down. So those other factors, so it's not that, Libya is a swing producer. So even if oil comes back from Libya, it's not a swing producer. This market is selling off largely because everybody is now worried about slowdown coming in the second half of this year. If that is the global backdrop, all asset classes in the short term will take it on the chin, which is what is happening. Now, what happens for India, we've been talking about it, that optically this market is at an all-time high, but the beneath the surface action, I think, is simply not very exciting. Now, when the momentum is either is stalling, or when the global cues are not on your favor, then you could be staring at more downside. I don't think this is going to be a pronounced downside because of liquidity and because of the way how the macros are moving. So I don't think this is a very large down. This market right now runs the risk of completely reversing. Having said that, you may see a big churn happening, which I think is evident. So for example, every uptick in defense and railways and shipyard and some of the government dominated stocks, use them to your advantage to sell. For example, yesterday there was a deep swell in some of the stocks, you should sell them. Similarly, on every bad day like today, and it could be tomorrow also, buy defensives, especially companies which would benefit largely because of government focus towards rekindling the rural economy. Third, if interest rates come down, NBFCs, they tend to benefit, which is what you should focus on. The first port of call is that on every bad day like today or tomorrow, you should start buying wholesale dominated NBFCs and don't buy private banks for the moment. These are the three trades according to me. Rest of the market, I think, could be volatile because of global factors, but sell government dominated stocks on uptick, buy rural facing stocks on every downtick, and shift your money from private banks to NBFCs only in the short term.
Okay, that's the take.